Let's begin what Anil Karnani, Professor Strategy from Michigan Ross University, has to say about sustainable development of an economy. He believes that we should treat the villagers as producers rather than consumers by encouraging towards income generating activities. One of the major initiatives from the government in the past few years is the financial inclusion. Because only 38% saved money in 2014, of which only 14% used the financial inclusion. The traditional way of achieving this through opening up branches at the customer's reach, or take the financial services to the customers through mobile banking systems. Some of the pain points about the Indian banking system is assessing the credit and credit penetration. Whereas it is performing relatively well in banking and debit penetration. To assess credit penetration issue, let's see the concerns from the borrower side who suffer from the inability to meet the traditional lending criteria, and the lenders suffer from the high cost of the lending. To solve this, let's use new technology enablers. To achieve the motive of the financial inclusion in India, one of the primary Prime Minister initiatives was Pradhan Mantri Jan Dhan Yojana. PMJDY works on mainly three pillars: UIDAI, bank accounts, and mobile banking, and develop the ecosystem for the banking system. How to use the financial inclusion to drive the economic growth? For this, we have interviewed stakeholders in the value chain of any banking customer. It involved business correspondents from Tier 3 cities, branch manager from some of the nationalized banks, and understood the BCs face significant challenges in reaching the last mile delivery. For this, we need to develop the alternative scoring model where there is less interaction between the business correspondent and the final consumer. Let's look at the new data sources that are available because of the emerging trends. Telecom providers are an important data source who help in identifying the probability of default. The logic being there should be the strong positive correlation between the probability of default and communication habits. History of bill payments can be a proxy for willingness and ability to repay. Retail buying patterns can help draw the consumer pen picture. Since majority of these consumers are SME owners, data from wholesale suppliers can be used to estimate revenue, and historical data from financial institutions might have ignored but important data. However, securing appropriate data from these resources will be tough because of the looming privacy concerns. Hence, we bring our big idea, an immobile application that drives data from past text messages. Almost every payment done to or from the sources suggested leaves a trail in the text messages. Analysis on data derived from these text messages will give us enough insights. The mobile application based on text messages also solves the data acquisition challenge because the only approval required is from the client. There are methods that can be used to analyze this collected data. We can use some of the techniques like discriminant analysis, logistic regression, neural networks, and decision trees can be used to analyze these collected data. Let us look into the value chain mapping of the customer journey and see where our idea can fit in. Banks can reach out to their target customers in the hearts and mandis by installing the kiosks. Customers request the loan through biometrics and the Aadhaar card. Banker can request the customers and assist him to installing the app and educate him using the app. App keeps track of the data following to into the customer message folder. Through which customer willingness to pay can be assessed. Our credit model assesses that we break even from year one alone as we incorporate the data driven from our app model. Though the costs incurred in the model are significantly brought down by reducing the non-operating costs from 40% to 30%, but we assume the risk of the NPA increases from 10% to 15% because of the no involvement of the business correspondent in the process, as we see in the traditional credit assessment scoring model. Also, it can be seen that the traditional model is used only when the risk involved and the loan size is high. And in every other scenario, our proposed model will outperform the traditional model. Thank you.